Hello everyone, good day. Good day, ma'am. Especially to our instructor, good day, ma'am. We are the reporter to our topic is financial market definition, primary market, secondary market, and money market. So I will be the reporter of financial market definition and primary market. What is financial markets? Financial markets, from the name itself, are any of marketplace that provides an avenue for the sale and purchase of assets such as bonds, stock, foreign exchange, and derivatives. Often, they are called by different names including Wall Street's and capital market, but all of them still mean one and the same thing. Wall Street refers to all banks, hedge funds, and securities traders that drives the stocks market and the whole financial system. However, the capital market are used primarily to raise funding, usually for a firm to be used in operation or for growth. Furthermore, these things are both same thing as financial markets, wherein group of people can trade in businesses or investors can purchase or exchange assets. Okay. Types of financial markets. Here are some types of financial markets. Number one is stock market. The stock market trades share of ownership of public companies. Each shares comes with a price and investors make money the stocks when they perform well in the market. It is easy to buy stocks. So, stock market is a kind of investment wherein pwede kang mahimong owner sa usa or daghan nga companies that you are going to buy in the stock market. Ito ay kung saan makikita mo yung mga companies, corporation that they trade shares wherein you are going to see the real time price. As we can see, it says that it is easy to buy stock, especially through online, because kanang pwede ka imong account wherein magbuhat kag account. After opening and funding your account, you can buy stocks through the broker's website in a matter of minute. The number 2 is bond market. The bond market offers opportunities for companies and the government to secure money to finance a project or investment. In a bond market, investor buy bonds from a company and the company returns the amount of the bonds within agreed period plus interest. Usually, the bond market offers opportunities. However, bonds provide income in the form of interest. Bonds is like utang that you should pay according to your agreement. Next, number 3, commodities market. The commodities market is when traders and investors buy and sell natural resources or commodities such as corn, oil, meat, and gold. A specific market is created from such resources because price is unpredictable. A commodity market is a marketplace for buying, selling, and trading raw materials or primary products, included agricultural products, mineral, and fossil fuels. These raw materials, agricultural products, mineral, and fossil fuels are going to buy and sell for those investors or traders or consumers. When it comes to trading, commodity trading is the exchange of different assets, typically future contract. The buying or selling of these future contracts, investor make bets on the expected future value of a given commodity. Number 4, derivatives market. Such a market involves derivatives or contract whose value is based on the market value of the asset being traded. The futures mentioned above in the commodities market is an example of derivatives. A derivative is a type of financial contract wherein two parties come together to agree on underlying value of an asset. For example, a futures contract about soybeans doesn't involve buying and selling soybeans. Instead, its value derives from a cost of buying and selling soybeans. In contract about this refers to a legal agreement to buy and sell a particular commodity assets. That is derivative market. Functions of the markets. The role of financial markets in the access and strength of an economy cannot be underestimated. Here are 4 important functions of financial market. Put savings more productive use. A saving account that has money in it should not just let that money sit in vault. Thus, financial markets like banks open it to individuals and companies that need a home loan, student loan, and business loan. So, this number 1, it is more productive. Our money or extra money is more productive when we put it in the banks as savings because we can help other people or individual when they access in it as a loan. Number 2, determine the price of security. Investors aim to make profit from their securities. However, unlike the goods and services whose price is determined by the law of supply and demand, prices of securities are determined by financial market. Goods and services whose price is determined by the law of supply and demand for being equal. Kung ang price of a good magtaas, ang demand for being equal ang supply ana nga good is ga-decrease, and vice versa. While ang price of securities are determined by financial market. Number 3, makes financial asset liquid. Buyers and sellers can decide to trade their securities anytime. They can financial market to sell their securities or major investment as they desire. In terms of liquid asset is an asset that can easily be converted into cash in a short amount of time. Number 4, the lower cost of transaction. In financial markets, various types of information regarding securities can be acquired without the need to spend. Importance of financial markets. 1. Financial markets provide a place where participants like investors and debtors, regardless of their size, will receive fair and proper treatment. Second, they provide individuals, companies, and government organizations with capital. Last, financial markets help lower the employment rate because of the many job opportunities it offers. Primary market. Primary market is also known as new issue market. Is where new securities are issued. It is part of the capital market. Corporation, national and local government, and other public sector institution can get financing through the sale, new stock. Nawala na. A primary market is also known as a new issue market, wherein new securities are issued. It is a part of the capital market. Corporations, national and local government, and other public sector institutions can get financing through the sale, new stock, bond issues through the primary market. So, ang new issue refers to a stock or bond offering that is made for the first time. Issue market is to facilitate transfer of resources from savers to users. The savers are individuals, wherein kita, and commercial bank, insurance companies. The users are public limited companies and government. Securities means kanang imong financial assets or financial instrument that can be traded. The primary market is something that came early in development or original. Second, the primary market is a source of new securities, often on an exchange. It's where companies, government, and other groups go to obtain financing through debt or equity-based. Which is, ang primary market, diha gikan ang financial asset and financial instrument nga pwede nimo siya i-exchange because usually sa primary market is exchange or pag binaylo ay through securities or financial asset into fund wherein pwede ang mga company or government or other group to obtain financing through those securities nga naka-base sa utang or equity base. An initial public offering or IPO is an example of primary market. This IPO or initial public offering refers to the process of offering shares of a private corporation the public in a new stock issuance. The primary market isn't a physical place. It reflects more than the nature of the goods. The characters of a primary market is the securities on it are purchased directly from an issuer as opposed to being bought from a previous purchaser or investor. Second hand, so to speak.
Good morning, ma'am. Good morning, classmates. These are the third and fourth topic that we have, the secondary market and the money market. Secondary market is where investors buy and sell securities they already own. It is what most people typically think of as the stock market. Those stocks are also sold on the primary markets when they are first issued, and these are the examples of popular secondary market are the National Stock Exchange, New York Stock Exchange, and the London Stock Exchange. These are the importance of secondary market. The secondary market helps measure the economic condition of a country. The secondary market provides a good mechanism of a fair valuation of a company. The secondary market helps drive the price of securities towards their genuine, fair market value through the basic economic forces of supply and demand. The secondary market promotes economic efficiency. Each sale of a security involves a seller who values the security less than the price and a buyer who values the security more than the price. The secondary market allows for high liquidity. Stocks can be easily bought and sold for cash. These are the difference between primary market and secondary market. There are two types of markets to invest in securities, the primary market and the secondary market. These two markets are often confused with each other. The primary market is a market where securities are created. In the primary market, companies sell new stocks and bonds to investors for the first time. It is usually done through an initial public offering. Small investors are not able to purchase securities in the primary market because the issuing company and its investments bankers are looking to sell to large investors who can buy a lot of securities at once. The primary market provides financing for issuing companies. And the secondary market, this is the market where securities are traded. Investors trade securities without the involvement of the issuing companies. Investors buy and sell securities among themselves. The secondary market does not provide financing to issuing companies. They are not involved in the transaction. The amount received of the security in the secondary market is income for the investors who is selling the securities. Types of secondary markets. There are two types of the secondary markets. It is stock exchange and over-the-counter markets. The stock exchange are centralized platforms where securities trading take place, sans any contract between the buyer and the seller. National Stock Exchange and the Bombay Stock Exchange are examples of such platforms. Transactions in stock exchange are subjected to stringent regulations, and the securities trading. A stock exchange itself acts as a guarantor, and the counterparty risk is almost non-existent. Such a safety net is obtained via higher transactions costs being levied on investments in form of commissions and exchange fees. Over-the-counter markets. No centralized place where securities are traded. In the over-the-counter market, securities are traded by market participants in a decentralized place. The market is made up of all participants in the market trading among them. Since the over-the-counter market is not centralized, there is competition between providers to gain a higher trading volume for their company. Prices for the company. Therefore, the best price may not be offered by every seller in the OTC market, since the parties trading on the OTC market are dealing with each other. OTC markets are prone to counterparty risk. And the money market. The money market is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities with average maturities of 1 year or less. It enables governments, banks, and other large institutions to sell short-term securities to fund their short-term cash flow needs. Money markets also allow individual investors to invest small amounts of money in a low-risk setting. Some of the instruments traded in the money market include treasury bills, certificates of deposit, commercial paper, federal funds, bills of exchange, and short-term mortgage, backed securities, and asset-backed securities. Large corporations with short-term cash flow needs can borrow from the market directly through their dealer, while small companies with excess cash can borrow through money market mutual funds. Individual investors who want to profit from the money market can invest through their money market bank account or a money market mutual fund. A money market mutual fund is a professionally managed fund that buys money market securities on behalf of individual investors. The purpose of money market. They provide a market for investors to earn a return on liquid assets. Borrowers who need short-term liquidity have access to these funds, and they provide the Fed with a means to effect monetary policy. The money markets include the following different types of instruments, each with different purposes. Functions of the money market. The money market contributes to the economic stability and development of a country by providing short-term liquidity to governments, commercial banks, and other large organizations. Investors with excess money that they do not need can invest it in the money market and earn interest. Here are the main functions of the money market. Financing trade. The money market provides financing to local and international trades who are in urgent need of short-term funds. It provides a facility to discount bills of exchange, and this provides immediate financing to pay for goods and services. International traders benefit from the acceptance houses and discount markets. The money market also makes funds available for other units of the economy, such as agriculture and small-scale industries. And the second one is central bank policies. The central bank is responsible for guiding the monetary policy of a country and taking measures to ensure a healthy financial system. Through the money market, the central bank can perform its policy-making function efficiently. And the third one, growth of industries. The money market provides an easy avenue where business can obtain short-term loans to finance their working capital needs. Due to the large volume of transactions, business may experience cash shortage related to buying raw materials, paying employees, or meeting other short-term expenses.